The Golden Week on the occasion of the Lunar New Year is over in China, and today, on the first trading day after the week-long national holiday, Asian stock markets perked up steam. However, the economic situation in China is in a jeopardy due to the deflation. India's fastest-growing economy in the region is gradually winning over Chinese investors. According to the Ministry of Culture and Tourism, Chinese travelers made 474 million trips within the country during the 8-day holiday, contributing to the largest migration rate in the world. However, many Chinese residents were in a long-term quarantines until December 2022. Under such circumstances, robust traveling activity around the country during the holidays is unlikely to happen again in the future. More than a year has passed since China's authorities abandoned the policy of long and sudden lockdowns, but the Chinese economy has not been able to recover and move on the strong growth. On the contrary, consumer spending in the country is declining. Business confidence has been undermined to such an extent that investor capital is flowing to neighboring countries. A slowdown in China's economy is likely to continue in the coming years, and as the country grapples with a worsening productivity and a rapidly aging population, the International Monetary Fund said earlier this month. The main winner from the decline in China's economy is the Indian stock market, which has been pumped up by billions of dollars. The South Asian giant attracted $20 billion in foreign investment last year, according to official figures. Over the past year, the Shanghai Composite Stock Index has plunged by about 13%, while India's benchmark Sensex has surged by about 17%. The Indian stock market even briefly overtook the Hong Kong Stock Exchange in January to become the fourth largest in the world. India is currently the fastest growing major economy in the world, and the World Bank forecasts its economic growth at 6.3% in the current fiscal year, which runs until the end of March. Wall Street giants, including Morgan Stanley and Goldman Sachs, have identified India as a top investment destination. Meanwhile, 3 Wall Street indexes closed in the red on Friday, following a non-stop 5-week rally. Still, the S&P 500 managed to stay above the landmark level of 5,000 points, even though figures on the S&P 500 are trading lower in the New York pre-market. Technically, the index remains in the bull territory. At the same time, the first resistance level in the area of 5,040 points acts as a strong barrier to further upward movement of the S&P 500. The index stays afloat in the light of a strong corporate reports from the U.S. companies and a growing hype about artificial intelligence. In this context, the earnings report of a semiconductor giant Nvidia, which will be released on February 21, looks very promising. In 2024 alone, the company expanded by 49%, and over the past 12 months by more than 200%. For comparison, at the beginning of 2023, Nvidia was 7th in the ranking by market capitalization. 3 years ago, it was 12th, and 4 years ago, it was not even in the top 20. Now, it ranks 3rd after Apple and Microsoft. After Wall Street fell, European stock markets followed suit and dipped on Monday before the release of important news on the Eurozone and the publication of the long-awaited minutes of the policy meetings of the ECB and the Federal Reserve. Investors prefer not to take risks. US stock exchanges are closed on Monday in observances of President's Day, but the currency market is beyond by the reports of higher producer prices and a significant drop in the cost of services in the United States. The data signaled sticky inflation and dampened hopes for an imminent rate cut. Thus, the recent statistics confirmed the stance of the Federal Reserve System previously voiced by several speakers, and the regulator apparently intends to maintain the funds rate at a record high level for a longer time. Vice Governor of the U.S. Central Bank, Michael Barr, spoke about the need to evaluate more economic data. However, he noted that it's too early to talk about a soft landing of the economy. Atlanta Federal Reserve Bank President Raphael Bostic believes that the regulator does not urgently need to cut rates, given the strong economic statistics in the United States. After Wall Street fell, European stock markets also went down on a Monday. The European Commission has published its latest economic growth forecast, downgrading growth prospects for the Eurozone to 0.8%. In addition, ECB President Christine Lagarde warned that strong wage growth could affect inflation dynamics. Arguments for cutting rates in the Eurozone in the first half of the year are not convincing, so before the release of important news on the Eurozone and the publication of the long-awaited minutes of the meeting of the ECB and the Federal Reserve, investors refrained from a risky bet at the beginning of the week. The euro-dollar pair regained losses of the previous week in full and even briefly climbed to 1.0788. Nevertheless, the critical level of 1.0800 remains untouched. The instrument has not made notable progress in its growth and closed almost flat for the second week straight. From a technical point of view, the overall trend is bearish. Low interest in loan positions is supported by a decline in consumer activity in the United States. However, the euro-dollar pair will be able to reverse upward. If the price continues to rise towards the 1.0795 resistance, and even better, if it goes above 1.0840. If events develop against the European currency, short positions may increase and send the pair towards 1.0700. And now the technical support levels are located at 1.0740 and 1.0695. Brent crude opened on Monday with a technical correction and dropped below $83 a barrel. The oil market is thin today due to the national holiday in the United States. Investors are still evaluating demand in China. The country is still the largest oil importer, and its reopening after a week-long holiday could stir up the oil market. Perhaps that's why black gold showed somewhat greater activity during the European trading session, and its price once again rose above $83 per barrel. For a sustainable rise in the oil prices, the market needs serious catalysts. In the meantime, its growth potential is still limited not only by the level of oil inventories in the United States and the aggressive rhetoric of Fed policymakers. There are also concerns about demand from Europe, which continues to slide into recession. Therefore, bearish sentiment in the oil markets is intensifying. The odds are that tomorrow the Brent price will begin to move down towards $82 a barrel. On the other hand, the level of 83.5 serves as a variable resistance level. If the price stabilizes above this value, an acceleration to 85 is possible. Until then, Brent crude is expected to trade in the intraday corridor between $81.50 and $83.50. You have watched a market review by InstaForex analyst for Monday, February 19. Subscribe to InstaForex TV channel and we keep you updated on the recent market developments. Don't miss our video. Your feedback is appreciated. See you online tomorrow.